Okay, for today's class session, we're going to be looking at mainly three different things. Non-current liabilities section that we're just going to be adding to that we've kind of already done some of these things. We're just going to be expanding like we've done in the previous chapters, like with the cash, we kind of expanded it to see petty cash and doing a bank rec. And then with the long-term assets, expanding those to see how you do mining or different depreciations. We're doing the same thing here. We're just moving down the line. So we finished the assets. Now we're going to be in the liabilities. Next chapter, we're going to move over into the owner's equity section. So the first thing I wanted to look at is payroll. How payroll is going to be a lot different compared to what we have been used to seeing so far. So far, when we've basically just been told that employees have earned a certain amount of money and then they're paid, and the entry would be very generic, something like this. And this would be okay if the person you were paying was a hired contractor. And there's a difference between an employee and an independent contractor. With an employee, you as the employer have to take out taxes. If they're a contractor, you don't take out taxes. You just pay them a flat fee, and then they are responsible for doing their own tax work, not you as the employer. But as most of you are at some point, or you are currently an employee somewhere, we're going to look at what you don't really know that goes on behind the scenes of your employer. So the first thing that I want to look at is I'm going to break this into two categories, and I've broken this down to just the federal type things that are taken out of your check, because there are a couple other ones down here that we'll talk about, but the three primary federal taxes that are taken out no matter where you live in the United States are going to be these three. And the first one is Social Security. So most of you have heard of that. You know that that's something that's taken out, but you probably don't have any idea how much. Social Security is taken out at 6.2%. Now in the book, they're gonna always give that to you. They don't expect you to memorize that. But if you go on into accounting, especially if you take our payroll class, Accounting 106, which is nothing but payroll, you will be expected to memorize this. And you'll be expected to memorize the next part, which is the cap. The book will also, in the problems, tell you the cap. Now, if you're still in the prior, if you're still in summer 2020, then this is the amount the book will give you. This is all the way back to 2017, the cap. The cap continually goes up every year just based on inflation. The percentage doesn't change. The percentage is kept the same. But the cap, as you can see from where 2017 is to 2020, that's a pretty big jump, just in those 3 years. For summer 2020, the book is going to have you use this as your cap, and I'll explain that. What that means is once your total wages for that year go above that cap, you no longer pay Social Security. So in a way, it's like a tax benefit for the rich, especially if you make over 100, in this case, 118,500. Now, it's a tax break, but then when you turn around and start collecting Social Security when you're old, then you only get to count this much as wages that you have made in that year. Even though you might have made $1 million, you can't start taking Social Security like you made $1 million and use that as your figure, as your wages. You have to stop it at the cap. So it kind of comes back, but just note with Social Security, once you hit a certain cap, you don't pay taxes, and we're going to see how that works in just a few minutes. Medicare, the book is going to give you this number as well, the 1.45%. The key with this one is there is no cap, so you're always going to pay at least 1.45%. These two together are what's known as FICA taxes. You'll probably have heard of that. FICA stands for Federal Insurance Contribution Act, and that's what is there for retirement purposes to help pay for, and this one is for your hospital stay if you have one when you are over 65, and then this is of course for your day-to-day living. It's kind of like a mandatory retirement plan for you. And then finally, your federal withholdings. The federal withholdings The book is just going to give you the amount because it's more complicated to figure out what your actual federal withholdings are. It all depends on how much you make, and it depends on your marital status. So the book is just going to give it to you. When we get into payroll, if you get into the payroll class, we actually start figuring out there. Then down below that, the book may go into further items, and some problems they do and then some they don't. For Indiana, of course, we're going to have 2 other taxes taken out, one for state and then one for county. So both of those are going to be taken out of your check as well. And then what you've probably, if you've never done anything with payroll, whenever an employer hires you and then they pay you, they're always going to have, and you need to remember this, a minimum of 2 journal entries. Because they're going to have your journal entry where they pay you and then take out these taxes. And then they're going to have a separate journal entry where they have to pay their own taxes out of their own pocket. And you don't even know this is going on. When an employer pays you money, then they have to then pay to the Social Security the exact same and just match it as what you did. They have to pay into Social Security. Same with Medicare. They have to match whatever you paid in. And then with the last 2 down here, these are the unemployment taxes. So if you ever file for unemployment, the money just doesn't come out of nowhere. It comes from the employer ultimately, because the employer is feeding this unemployment system. FUTA stands for Federal Unemployment Tax Act. And notice it's very, very small. It's only 0.6%, or as a decimal, 0.006. And it's capped at $7,000. And then SUTA, well, that depends on state by state, because that stands for State Unemployment Tax Act. And the book, it's going to tell you the cap is $7,000. In Indiana, it's a little bit higher than that. It's $9,500. But we're always going to use what the book says, and it's going to say $7,000. And then they're going to give you the percentage, because the percentage differs per employer. If you don't lay off very many employees, then your percentage is going to be very, very low. You shouldn't have to pay into the system very much. But if your employees take out a lot of money because you are constantly laying people off, then you should be paying more in. So that's how that works. And the book is just going to give you a percentage. It's going to say 2.9%, for example. And then you're going to do the journal entry. So let's get into an example. There are other things that, of course, taken out of your check. If you have medical insurance premiums, that's coming out of your check. If you have 401k that you put money aside into your retirement account, that's coming out. If you have court-ordered garnishments, say like you're behind in child support, that's going to come out of your paycheck. Other examples would be like flexible spending, money you pay for that goes into medical, that you can pay for medical bills. But let's get into an example. I have this employee, and I tell us that their previous earnings, what their previous earnings are. And that's important for cap reasons, for Social Security and or FUTA and SUTA. Now, if this employee's only made $6,700, they're nowhere near the Social Security cap of $118,000. They're a long way away from that. But we're very, very close to the FUTA and SUTA wages. And we're gonna update a few of the numbers here in this example as I go through. Because my FUTA and SUTA are going to be a little bit different, and I'm going to take these. I'm going to go ahead and take these out as well. We'll just have the Fed rate, the SUTA rate. Now, let's put in here, because the book is going to give this to you, so I might as well too. 6.2% Social Security, and let's use the cap of 118.5, even though that's not going to come into play. The book will also tell you 1.45% for Medicare. When you open your sheet, of course, it'll already have this on there. I'll upload this most current copy. I just forgot to update it from what I use in my classroom. I use more up-to-date numbers instead of the older numbers, and I also use some state numbers. But let's get into this one and see how it works. So this employee earned $1,000. Just like my person up above, where we just did wage expense 1,000 and credited cash. Well, now it's a little bit more complicated than that. We have SUTA taxes at 4%, and let's say this is capped at 7,000, just like what the book will show. We'll have to remember that there are FUTA taxes. So FUTA is 0.6%, and that's also capped at 7,000. The Fed, I tell you 5%, so we'll just take 5% of the 1,000. And then Social Security, and then Medicare. All right, so how we start this one out? We started out exactly the same as what we did above with our really easy example. Wage expense 1,000, that's what the employee made, that's what I'm having to pay out. Now, the difference is I'm not paying the employee exactly 1,000 because I'm gonna break that 1,000 down into different categories and then show, let's take this out of here, and then show where those amounts are going. So out of the 1,000, the first 6.2% goes to Social Security. So if you take 1,000 times 6.2%, it's $62. Medicare, if you times 1,000 by the 1.45%, that's what you're gonna get for $14.50. 5%, I tell us for the Fed, or $50, goes into the federal withholdings payable. These are all amounts that I'm going to have to pay to the IRS within probably the next month, within the next month generally. And then whatever's left after all the taxes are taken out, that's what I then write a check for to my employee. So on this one, I'm just going to get out the calculator and take 1,000. I know you can't see this, but take 1,000 minus 62, minus 14.5, and minus 50. That leaves $873.50 is what I would write a check for. Because you never, as long as you're an employee, you won't get a check for exactly how much you earned. Now, remember we said that there are 2 journal entries. This is just the first one. This is just showing your payment as the employee and then where the rest of your money is going to eventually go to these 3 departments. Now we come down to journal entry number 2. Journal entry number 2, let's stop it right here. We're going to have one debit, just like how we did above with wages expense, because we knew what that was. It was $1,000. We're going to have one debit here. It's just we don't know what it's going to be until we do all of the credits, until we take and figure up all of the different amounts that the employee has earned or that the employer owes. So remember, if we go back up to my little cheat sheet here, the 4 things that the employer has to pay in addition to what the employee pays. Social Security and Medicare are exactly the same. So I'm going to credit those, if you remember the 2 amounts. I'm going to put another $62 that I owe Social Security and another $14.50 that I owe Medicare. Then we go back up and let's look at our final 2 items, the FUTA and the SUTA taxes. And then SUTA, the key thing here is it's capped at $7,000. So once I hit that threshold, I no longer pay FUTA taxes for that employee. And we're going to pay taxes at this very low amount, 0.6%. Now remember the 7,000, because our person here has made $6,700. So once we know, if I take my old earnings, my previous earnings, plus my new stuff, if that amount goes over the cap, then you have to figure up what's left. And if you add these 2 up, it definitely goes over the cap. These 2 added together is $7,700. So what I have to do then is figure out how much do I have left to get to the cap from where I started out. So I started out at $6,700. The cap is $7,000. The difference between $6,700 and $7,000, there's $300 there. That's all the more that I'm going to pay tax on. So when I come down here and do my journal entry and figure out how much I owe FUTA, I only owe them 300 times 0.6%. So if you take 300 times 0.006, then you're gonna get this $1.80. And then I told us that the cap for SUTA is the same, $7,000, which for the book problems it will be. So we still only have $300 that I need to tax. And then if you go back up to the problem, it tells us that the SUTA rate is 4%. So I'm simply going to take 300 times 0.04, and that's $12. So I'm going to come down here and update this to $12. Now I've now calculated all 4 taxes. I can then enter in all what my X's are. And so I'm going to go ahead and add up the $12 plus the $1.80, $14.50, plus the 62 bucks. And my debit, when I'm ready to enter in this debit, it really will be, let's show our X here it is. Our X number here is $90.30. That would be our debit to this entry. That's how much in total taxes that I paid, in addition to what the employee paid. Okay, so the key thing you're going to want to remember are the caps, and then which taxes each person pays. Does the employer pay it? Does the employee pay it? Or do both of them pay it, like Social Security and Medicare? So we'll see some more examples of this when we get into the problems in our problem part of Connect.